Hi, everybody. Really glad to see all of you join this webinar again. And I'm really glad that we have Sujoy with us again. Sujoy has done multiple webinars for us in the past as well. And we're really happy that, he's here with us today once again to help us out with this webinar as well. I want to introduce our partner for today, which is OAWA. And before that, let me introduce you to the speaker. Speaker, as I said, is Sujoy Das. He's a co-founder at OAWA, and they are our partners for today's webinars. They are a platform that help you learn about financial planning, and I'm sure they will take you through the platform and what the platform does. But before that, let me introduce the session to you. We're doing a session on mastering financial success, and Sujoy is an expert. He has over 25 years of experience in fixed income and the currency market, and I'm really happy to have him on board even today. With that, Sujoy, I think I will take your leave, and I hand over the session to you. Thank you so much for doing this for us again.
Great. Thank you so much, Shruti. Wonderful. And I welcome everybody in the session today. So we are going to spend the next 1 hour trying to master some kind of financial nitty-gritties, and particularly the strategies that we are going to talk about is for a busy corporate professional. All right. So on that note, let's begin. So we definitely have the chat box. So you can keep writing in the chat box as and when I'm asking questions. And there would be a lot of engagement. There are quite a few polling questions and so on. All right, so let's begin. Next slide, please. Request Ihina to move to the next slide, please. Okay, so my name is Sujoy Das. I've been associated with the banking and financial services industry for the last 25 years. My expertise is primarily around currency, interest rates, equity, and the credit markets. So today we are here to work on the financial nitty-gritties for a busy corporate professional. Next slide, please. And the next slide, please. All right, so let me first congratulate everybody. So obviously the investment in knowledge pays the best interest, says Benjamin Franklin. So thanks for taking time out of a busy schedule. Let us see what's in store for the next 45 minutes to an hour. Next slide. So now in this 1 hour, we are going to talk about 4 different parts. One is we are going to look at some kind of investment wisdom. All right. Then look at some wealth growing opportunities, look at some risk management and future planning. Next slide. So are you looking to navigate the complexities of finance and investment? So both for career growth and personal finance mastery. If your answer is yes, you keep moving it as I speak, okay? So I'm not going to speak out, okay? Please move it when I'm speaking. So let's simplify, because finance sometimes could be really very, mystic word, okay? So we would try to demystify financial jargons. We would slay the financial dragon, and we would look to simplify your journey in the whole process. So do you really find financial management, do you find time amidst a busy schedule overwhelming? So if your answer is yes, so there is a solution, okay? Let's look at the solution. So the solution is, we definitely need to break down financial management into manageable steps. Before I move ahead and talk about the other parts, let me ask you a question. So there is going to be a polling question coming up now. So where do you envision your financial status in the next 5 years? And how do you plan to reach there? May I request everybody to start answering on the polling question right now? Last 10 seconds. 5 seconds. All right. So we have the results, and the results are uh, building wealth and securing the future. Great. So wonderful. Thank you very much for your answers. Super. Let me move ahead. Let's go ahead, please. So in this world, when we talk about financial management, sometimes it might be quite very, difficult to even comprehend at times. Like, what do we really mean? So suppose somebody is the age of 35 years, and we say that, you know what, you need to do some kind of financial management. So people starts to shake. People really don't know what to do at the first stage. So in this process of financial management, we, we feel that financial management is actually quite easy compared to what it is generally made out to be. We generally talk it in the manner that it becomes quite complex and difficult to comprehend at times. So we need to take really small little steps at one time. Okay. So one is that in this whole process, there is something called a goal. Everybody needs to have some kind of goal. Like, where do I want to reach? While we want to reach that level, there has to be small little budgets for ourselves. And there is one very important part in this entire financial management, and we are going to discuss about that, is that we need to dedicate some hours every quarter, maybe 1 or 2 hours or 2, 3 hours every quarter to check like whether we are on the right track. First is step one, identify and figure out your goal. Step two, identify the budget. And third, step three is to dedicate some time to track whether we are on the right path. Let's move ahead, please. So why is this simple? Amongst all these three things, there is one small step which I said at the end, which is like reviewing the finances. And that is actually the most important thing. And why is this simple step so very effective? It is effective. Let's move ahead, please, Ihina. So it is effective in order to gain clarity and control over our money without disrupting the routine. Because we are all in a journey. We might be 25 years old, we might be 30, 35, 40, 50, whatever we are age, all of us have a goal to achieve. In that whole process, it will not be possible for us to stop and pause for some time. It is a continuous, present continuous tense. We are always moving ahead in that journey. While we are in that process, we are moving ahead, there is always great discipline to stop and get some clarity and control over the money without disrupting the routine. So that is the most important step in this entire financial management. It is goal setting, budget, and finally the control. Please move ahead. Please move ahead. Now, is in this whole financial management, there is one slide back, please. I'm out of the inflation. Yes, please stay there. Okay. So in this whole process, there is one very important, hurdle rate that we all need to cross over. And that hurdle rate is the inflation. I'm sure all of you are corporate professionals. You would be all investing your money in some place, maybe in a bank. You might be depositing your money in a bank. You might be making some investments in the equity markets or maybe through an equity mutual funds. But the whole thing that we want to ultimately achieve, or the final thing that we want to ultimately achieve, is that all of us want to beat the inflation. Because inflation is the elephant in the room, right? Because that actually erodes large part of our income. Whether we are earning 7% through our deposits or we are earning 12% in our equity markets, if the inflation is really high, then it actually erodes large part of the income. This whole process of expense budgeting, controlling spending, and so on, and finally your investments, is the final goal is to beat inflation. So in this entire financial management game plan, the first thing that we need to forecast is to figure out in which direction is the inflation headed. Is it going up or is it coming down? All right, let's move ahead. Okay, so what are the basics of investing and how can we get started? Move ahead, please. From chaos to clarity. So there is a financial roadmap. Please move ahead. As I'm speaking, please change the slides, please. All right. The first step is to identify your short-term goals and your long-term financial goals. So the short-term goals, you can please write in the chat box, those of you want, like what could be a short-term goal? So can somebody write examples of short-term goals that you have in your mind? What are short-term goals? What are the short-term goals? Quickly write in the chat box. What are the short-term goals? Do you have an ability to write there in the chat box? I'm not sure.
Yes, yes. You can check in the Q&A section. People are writing, Sujoy.
Okay. Got it. Yes. Okay, planning for a vacation, buying a car, international trip, kids' school fees, so on and so forth. So that's a short-term goal. Can somebody quickly write 2-3 examples of a long-term goal that you have in mind? Long-term goal. Quickly. Long-term goals. All right. Long-term goals. I have quite a few examples of short-term goals. Yes, we have retirement. Yes, retirement definitely is a long-term goal. Buying a home could be a medium-term goal. Absolutely. Great. So the first step in this whole process is to identify your goals. Okay. Because unless and until we have that step ready, nothing really works. Let's move ahead. The second step is to break down, like for example, let's say we would like to buy a house, let's say in 10 years time or 5 years time. Okay, let's say 5 years time. So we need to identify, like, okay, what could be the budget of the house, and then break it down to achievable milestones. So suppose it's a 1 crore rupee worth of house that we are possibly looking to buy, then we need to identify that, okay, out of this 1 crore rupees that I need to set aside, maybe I set aside 50 lakh rupees, 50 lakhs I go for a loan, and that 50 lakhs I break it down and say, okay, I will possibly save enough to reach 10 lakh rupees in the first year, another 10 lakh rupees in the second year, and so on. And then we work down backwards to see whether we are doing enough to reach that 10 lakh rupees. So these are the steps that we go through. Okay, please go more ahead. Okay, so by creating a simple budget, which will actually align with the priorities, okay, and it will take away the guesswork from our financial planning. All right, let's move ahead. So let's do you want to embark on an investment journey with some confidence? If your answer is yes, let me see how many yes there in the chat box. How many are looking to move ahead in the investment journey with confidence? Please write yes in the chat box. Quickly. All right, super, great. Let me move ahead, please. Super. I've got 100 years coming in. All right. So let's move ahead. Mastering the money. So we need to, first thing is that we need to tame our spending habit. Whatever we earn as salary, everything cannot be spent. We need to reduce our spending or make some discipline around spending. Number one. Move ahead, please. Can I have the next? Yes. So there is a very simple 50-30 rule, 20 rule. How many of you know about this 50-30-20 rule? Write yes in the chat box if you're aware of the 50-30-20 rule. So the 50-30-20 rule is a very powerful but very simple rule to follow. Okay. Do we know what is this 50-30-20 rule? So 50% of your income you spend on your needs. Okay. Your need could be food, clothing, and so on. 30% of your income you actually spend on your wants. All right. So it is there is a difference between need and want. Want could be your entertainment, party. That is not what you need, but it could be that you want. So 50% on your needs, 30% on your wants, and 20% definitely you need to save. 50% on needs, 30% on your wants, and 20% of your savings. This is a very simple, easy to follow budgeting technique, which would put a lot of discipline in all your expenditures and so on. It will automate your savings and set up automatic transfers to maybe certain savings accounts so as to enable this happening. Clear? Can I have a thumbs up? Yes, from everybody who has followed this simple budgeting technique, 50, 30, 20 rule. Quickly write, yes, I follow in the chat box. Yes, I follow in the chat box. All right, super. Okay, super. So 50% of your income you set aside as your needs. Needs are something which you really need to spend upon, like your food, clothing, electricity bills, and so on. 30% is on your want, which is could be a certain entertainments kind of stuff, partying, going out, gifting, so on. And 20% is on your savings. All right, super. Let's go ahead. Let's move to the next slide, please. Because the wise man, according to a Bible proverb, the wise man saves for the future, but the foolish man spends whatever he gets. So the first discipline is to let's tame our expenditures. Let's not spend everything that we earn. Please move ahead. So do you want to learn about investment strategies which are best suited for busy corporate professionals? Then stay on and we will going to discuss about that. Let's move on. Move on, please. We will embark on an investment journey. So, for many of us, investments might have already started. For many of us, investments might not have already started. Okay. So, the solution for those people who have already started, we need to take to the next step. But for those who have not yet started, the time has come to take the first step. The solution to each of this is start with a low risk, beginner friendly investment option. And there is no other better option than an index fund of a mutual fund. Okay? Index fund. Please write, yes, I understand. So I will definitely start with an index fund of a mutual fund. Please write, I will, in the chat box, quickly. Those who have followed this, please write, I will, in the chat box. Index fund. So index fund is a very simple product where the overall market risk is substantially reduced. Okay, you are not exposed to what a fund manager does or does not do. Okay, and you would get the return what the markets are delivering, and it is an extremely low cost. You are not spending too much to get access to that kind of return, because in a mutual fund you definitely have to pay for the fund management charges. Okay, but for the kind of returns. But in the index fund, you need to pay charges, but the charges are extremely low. So index fund is a very beautiful first step for all beginners to start in the market. Because in the market, if we are looking for returns, we also need to take on risk, because we all understand risk and return go hand in hand. If we don't take risk, the chances of return are diminished. Okay, but if we take too much of risk, then the chances of return are substantially diminished. So we should know how much of risk to take so as to get a commensurate kind of return. Index fund is a great first step for all beginners to start your investment journey. Clear? I think there was a question like, can you explain it? So this could be a first very, very great, powerful step. Okay. All right. Let me go for one more polling question. One more polling question. And this time I want 100% of you to answer, please. What hurdles do you face in achieving your financial objectives? What hurdles you're facing to achieve your financial objectives? Quickly, maybe 20 seconds maximum. All right. Option A, balancing expenses and saving for the future. Option B, managing debt and investment risk effectively and coping with economic uncertainties and market fluctuations. 3. Can I have 100%, please? Last 5 seconds. Quick. 3 seconds. All right. Let's see the answers. So we get 46% of you who have selected option A, which is balancing expenses and saving for the future. This actually is a problem with many of us. Because the kind of income that we get, we end up actually spending large part of it. We do not have a proper budgeting and so on. Okay. So then there is a beautiful way to start off that. And you can all of you start off with the 50-30-20 rule. Okay? 50% on your needs, 20%, 30% on your wants, and definitely 20% on your savings. All right, super. Let me move ahead. Next slide, please. With minimal time and effort, you can actually start your wealth building process through passive investing. So index fund, which we are talking of right now, is a great way of passive investing, because there are two kinds of investing. Okay, active investing and passive investing. In an active investment, the fund manager of a mutual fund also plays a role to the extent that you would generate your money. But passive investment is actually the new rage in the Western world. And index fund is a one very powerful fund to start your passive investment journey. Okay, so it goes on with very little maintenance. So it could be a great, beautiful first stepping stone. Next slide, please. So how would you effectively manage risk and protect your investment portfolio? Because when you are entering the market, you are entering the market to generate extra return. But when you are looking to generate extra return, you are also, embracing little extra risk. Okay. So now we will understand how can we effectively manage risk and protect our investment portfolio. Let's move ahead. In this way, what we can do, can I completely eradicate risk, in my entire investment journey? Answer is no. There will be always some risk when we are looking for that extra return. But if we go for hands-off investment solutions, like for example, target date funds. What is a target date fund? Target date funds are funds which have a definitive end period. That means, suppose for example, let me give you an example. You are looking to buy a house, let's say in 5 years' time. You invest in a fund which would also have a payoff at the end of 5 years. It will not be 4 years, it will not be even 6 years or 7 years. It could end in 5 years' time. So you have a target, investment in that fund, which also more or less matches with your investment horizon. So it's a very great risk mitigation tool. You are not taking too much of market risk beyond what is actually necessary. So that is one. Second one, going for those funds which are professionally managed, because we ourselves might or might not have all the wisdom and knowledge to manage our own money effectively. But there are a group of people or fund houses whose profession is to manage money. They look at markets, they identify the risk, and then invest into those. So get invested into those kind of funds. That would be a very good mitigation tool. Please move ahead. So, but while we are investing in the market, we would always be concerned about losing money. Correct? How many of us agree to this question, right? Yes, I agree. Quickly in the chat box. Yes, I agree. If you agree to this, right, quickly, yes, I agree. Because whether you are Mukesh Ambani, doesn't matter. Whether you have made money for the last 20 years, doesn't matter. When you're looking to make the next investment, you will always be worried. Investors in general are always worried because nobody understands what is going to happen next. Markets are uncertain, and hence the return expectations can also be different. Okay, let's move ahead. So, since return expectations can really vary, markets are uncertain. So, one very golden step to take over here is to diversify investment across multiple asset classes. Okay. So, when I say multiple, it means different kinds of asset classes. It could be in equity, it could be in fixed income, it could be in commodities, it could be in currency, it could be in offshore, it could be in real estate, it could be in art. There are multiple asset classes. And why is it important? It is important because suppose, for example, equity prices are going up. That doesn't mean gold prices will also go up. Or when gold prices are going up, it doesn't mean equity prices will also go up. If something goes up, others may come down a little. So actually, this process, the correlation of one asset with another could be negative. That is actually overall your returns might not be super great, but your risks or your downsides will also not be super bad. So if we diversify our investments across multiple assets, our overall returns get optimized. So that is the word. Our overall returns get optimized. So we will not get super duper returns, but we will not get super bad days also. So diversification is a great risk mitigation tool. All right. So suppose you are investing in a large cap, please identify some mid cap or some small cap stocks also. In that whole process, it is magnified. If you have followed this, please write I followed in the chat box quickly. Right? I followed in the chat box. Okay, super. Super. If you have followed this, right, I followed. All right, super. Let's move on to the next slide, please. Next slide. So we need to have a very disciplined, because sometimes, or most of the time, not sometimes, most of the time, as investors, we become very emotional. So this is a very big point that I'm going to say right now. We need to detach ourselves from our emotions, sentiments, emotions, because market may, if you are looking to generate income, it is all about probability. And I keep telling the story. Suppose you have one stone in your hand, and then there are two mango trees in front of you. One has got 2 mangoes, and other has got 500 mangoes. Which tree will you throw your stone? You won't throw your stone on the tree which has got 2 mangoes. However emotional you will be, you would select the tree which has got 500 mangoes. Correct? That tree which has got 2 mangoes might have been planted by you. It might have been watered by you. The same goes for investments. You might have done your best research and you have identified something, but if that is not working, then you don't invest in that. So you need to have a very disciplined investment strategy, and you need to follow the laws of probability and detach yourself from emotions completely. I'm going to narrate a story over here right now. Okay, I'm going to narrate a story. And before that, let me ask you one quick question. One quick question. Okay, I'll come back to that question. Can I have the next slide before I start narrating the story? Okay, mutual funds. Okay, so I'm going to talk about mutual funds, but before that, I'm going to narrate a story. And listen to the story very carefully. I'm going to ask you a few questions also in the process. So during the COVID times in March 2020, the equity markets came down, correct? So people like you and me, we were actually very worried because the markets actually tumbled by 40% in a matter of 3 weeks. Okay, and all of us were worried about our salary, our income, our jobs. Everybody was work from home. We did not go to the shops and so on. So the shopkeeper also did not make any money. Everybody was in our homes, and the economic growth actually tumbled. Okay. Now, when the economic growth tumbled, situation became very worse, or it moved from bad to worse. In the worst of the times, the equity market fell, but it did not fall forever. If you go back and see what happened in March 2020, the equity markets fell till some point and then it turned around. It turned around and it went up massively. How many of you remember what happened during that time? Please quickly write, I remember. Do we know what happened during that time? So today's story is all about what happened that time. Please write, I remember. Quickly in the chat box. Yes, equity markets turned around and started to go up, and it has been going up ever since. Do we know the reason why it went up? It went up. It went up because of one very powerful thing. And that powerful thing is what we call interest rates. Interest rates play the most important role in your wealth creation journey. And today I'm going to narrate a story about why it happens. Because when you're investing in the market, you're investing in the market to make more money. Suppose you're investing in a stock which is at 20 rupees. You want the 20 rupees to go up from 20 to 25. When will it go up from 20 to 25? when the demand is high, correct? When more people are investing in that stock, and the prices go up when the demand is high. And when is the demand high? Demand is comprised of three things. Number one, people should have a desire to buy that. Number two, people should have an ability to buy that. They should have money. And number three, they are willing to spend that money to buy that product. If tomorrow I say, okay, I love Mukesh Ambani's house in Mumbai, that doesn't mean Mukesh Ambani's house has seen higher demand. No, that means only I have a desire for that house. Number two, suppose I have got 10,000 rupees in my bank, that means I have an ability to buy that house. Doesn't mean the demand has gone up, but demand will go up when I'm willing to spend that 10,000 rupees which I have in my bank to buy that house. The same rule applies to equity markets also. When you do your research and you find out a great company, you're picking up your desire. Your desire is getting established. When you have money in the bank, that means you have an ability. But your willingness to take that money from the bank to invest in the market will happen when the interest rates are lower. When interest rates comes down, we people who keep our money in our bank as a depositor become unhappy. When we become unhappy, as the depositors become unhappy, the depositors shift the money from the bank to the market. When people shift money from bank to the market, that is when prices go up because people are buying. Clear? So, as investors, this is the most powerful thing that we should look for, is that whether interest rates in the banks are coming down. Because when you're investing in the market, you want the prices to go up. Whether it will go up, how do you know? Whether what you have liked is also liked by somebody else. You would never have control. You might like something, somebody else might not like it. But you would be able to know when everybody's decision gets impacted by interest rates. You have to look for a common factor. And the common factor in the market is interest rates. Because whatever you buy, whether you're buying your house, whether you're buying gold, whether you're buying commodities, you're always buying with money. And money is kept in a bank. And bank pays us interest rates. If interest rates goes down, our interest to keep money in a bank will be lower. So if you don't want to keep money in a bank, we have to look for an alternative. And that is when the money shifts up. Clear, everybody? Did you get it? Please write quickly in the chat box whether you understood the story. I understand. Quickly. The most powerful reason why markets go up is when interest rates offered by banks comes down. Please write in the chat box, I understand. Absolutely. Right? 100% I understand. This is the most powerful singular reason. It can change investor sentiment. It can change market sentiment. It can pull in more money. It can create dramatic results. So what happened during the COVID times is the very same thing. Because as interest rates, so as the market tumbled by 40% during COVID, interest rates were also pulled down by 200 basis points. And that created a large group of unhappy depositors. When depositors in a bank become unhappy, we look for an alternative. Despite us losing jobs, getting lower salaries and so on, we were forced to look for an alternative. And we moved into the capital market. We came into that and started investing in the capital market. And now, as we move into the capital market, many of us come in, market prices start to go up. Because prices will go up when more people buy. There's a question. So now that interest rates have started increasing, but markets are not down. In fact, they are doing very well. Absolutely. Because as interest rates did go up, but there were more money which came in, not just from India, from other parts of the globe. And now the story has begun that possibly there is a rate reduction around the corner. So the entire cycle of rising rates post-COVID that really happened. So like the 2022 and 23, when interest rates were pushed up, markets did not tank much. In fact, it started to go up. In India, particularly, it went up because of a variety of reasons. But in many other parts of the globe, it tanked a little. But it has again started to go up because the feeling is that interest rates are going to come down once again because the inflation is cooling off. All right, let's move ahead. Let's move ahead. So unlocking the power of mutual funds. Yes. Quickly, let's move on. Next 5-6 slides quickly. Okay. So we talked about low-cost index funds. So this is a very powerful product to begin with. Okay. So all those who have not yet started, start with an index fund or an exchange traded fund. Number 2. Move on. Mutual funds is a hassle-free investment. Okay. So you don't have to look into your investments on a day-to-day basis. There is already a professional fund manager who's looking at it. So it's actually a hassle-free investment zone. So many people actually have created enormous amount of wealth by getting invested and staying invested through mutual funds. Yes, please. Move on, please. And Ihina, we need to move a little faster, please. So next slide, please. So how do I build my investment portfolio? How do I build my investment portfolio? Move on. Quick, please. Okay, so ETF we discussed. Next slide. Okay, so when we start, we generally start small. Okay, always make a habit that you keep adding to your investment as much as you possible. Okay, so that you eventually create larger pool. Always keep adding. Move, please. Stitching time always saves time. Move ahead. Okay, navigating the economic terrain. Move ahead. Keep moving. Keep moving. So economic trends. Yeah, let's move ahead. Keep moving, Ihina. Always focus on the long term. So there are two things in the market. It's a noise or a trend. Eventually, the markets are upward sloping. You are not here in the market for the next 3 months or 6 months. So always have a long-term vision in mind and keep moving ahead. Okay. Avoid the temptation to time the market. Generally, many of us have this, false hope that, okay, I will have a great entry time and a great exit time. It doesn't really work. So consistent long-term investments are the people who are great investors. Rest of the guys are all traders. Traders eventually do not add up to make money. Investors are the guys who actually end up and make more money. Please move ahead. Go ahead, please. Go ahead. Okay. So interest rates. So as I said, diversification is a great tool to stay focused so as to reduce the risk. So even in this interest rate journey, the story that I narrated is the most powerful singular reason why stock markets or any asset classes prices go up. Okay. Go ahead, please. Go ahead. All right. So retirement. So everybody, eventually we will all retire. We might be 20 years to retirement age or 30 years to retirement age or 10 years to retirement age. So are we prepared enough for the golden years post-retirement? It's something that sometimes play on our mind, but for most of us, it actually is always pushed out in the future. Nobody really talks about it much. But I think it's a good discipline to start, taking some steps towards that. So first is to identify how much am I spending in today's times. For example, if you are spending on food, let's say 20,000 rupees a month, okay, in today's times, and your retirement is, let's say, 10 years later. I'm just giving one example. So suppose you are spending 20,000 rupees on food now, and your retirement is 10 years later. We have to use inflation to figure out what would be the value of 20,000 10 years later. So suppose it reaches to, like, let's say 30,000 rupees. So I'm going to spend 30,000 rupees on food 10 years later. Then I need to see that how much should my pool of investments be so that it will generate 30,000 rupees month on month after 10 years. Okay. So you always back calculate to figure out whether you are saving enough to create the pool which will generate sufficient returns post retirement. All right, move ahead, please. Okay. So what I'm going to request all of you is that I would request Ihina. So all of you have been in this webinar for the last 40-45 minutes. So we would end in about another 20-25 minutes and so on. We are going to talk about that. I would also request, so if I would invite all of you to be part of a very premium, corporate circle. If you want to be part of the corporate circle and would like to know what is really happening in the world of finance and wealth management, and most importantly, get a financial health checkup done for yourself. Okay, whether if you want a financial health checkup done for yourself, I would invite you to join the WhatsApp group or a community group. Okay, we have created a very premium WhatsApp community group. The link will be in the chat box. May I request each one of you to click on that link and join the WhatsApp community group. Okay, so may I request Ihina to post the link of the WhatsApp community group in the chat box, please? Yes. So the WhatsApp community group link is there in the chat box. All of you who want to be part of that health checkup journey and so on can click on that link and join that group, and you would receive all kinds of updates about finance, investments, and also get your financial health checkup done. And there will be exciting stuff even for school-going children. So if you have school-going children, I'm not sure how much they be aware about financial literacy and awareness, can also join that group to know something interesting coming up from tomorrow. Okay, so you join the group and we would post something interesting in about an hour's time and we'll get to know about that. All right, let's move ahead. So the link is there in the chat box. All of you are requested to click on that link and join the WhatsApp. All right, let's move ahead. Next slide, please. Okay, so what did we learn so far? What did we learn so far? So we learned that we need to definitely set clear goals, okay? Automate our savings and follow a very disciplined budgeting technique. So the 50-30-20 rule needs to be followed. Number two, markets have an ability to generate a return higher than inflation year on year. That is there. Now, in order to be part of that market, we can definitely start small and start with an index fund. Okay, so index fund is a great tool to start your journey with. Okay, choose low cost options. So there are multiple options in the market to get invested, but choose low cost options because the high cost items sometimes do not add up. Okay, maintain discipline and your long term focus. Do not get swayed by your short-term noises in the market. Because the markets are here for long term. Nobody invests for 2 years, 3 years, 5 years. We all invest for eventually 10 years, 20 years, 30 years, and we also keep our money for legacy, right? For our next generation. So, idea is to have a very long-term horizon, and we calculate our retirement needs effectively. All right. Let me ask you a polling question coming up now. How confident are you in managing your finances and investments? Quickly, how confident are you in managing your finances and investments? Can I request everybody, please? All of you, please. All the hundreds of people who are here. Last 10 seconds, quickly. Okay, let me just publish the results. Okay, so I see moderately confident. 1 second. I see 1 second. The answers. How important confident? Okay, which 47% is moderately confident, but value continuous learning. Okay, super, great. Let me ask you one more question. Back to the results. Let me ask you, what is the most pressing challenge in achieving a financial goal? What is the most pressing challenge? We will put maybe 15 seconds to answer this, please. 15 seconds. 5 seconds, please. What is the most pressing challenge in achieving? 1 second. Let me just quickly check the answers. A minute. Okay, great. Let me see the answers. Number one, lack of financial knowledge and expertise, 38%. Limited time and resources for managing finances. Okay. Super. Back to results. And if presented with an opportunity, yes, we presented with an opportunity to gain expert knowledge in finance and wealth management, would you seize it? Will you seize it? Can I have 100% of people answering this, please, quickly? And I'm going to give, let's say, 15 seconds for this. 15 seconds. Last 5 seconds. Last 5 seconds. 3 seconds. 2, 1. All right. Let's see the answers. 59% of you believe that you do recognize, what are the answers? I do recognize the importance of continuous learning and depending on the relevance and value of the opportunity. All right, super. Okay. Can we move ahead, please? Ihina. So if you buy what you do not need, soon you will have to sell what you need. Okay, says actually it's a very old biblical proverb, but it has been attributed to Warren Buffett as well because he has been speaking about it. Okay, can I move ahead, please? So, do you want to really take control of your financial future and elevate your professional standing in this competitive corporate world? If your answer is yes to this question, please write quickly yes in the chat box. And we have something exciting coming. Please write yes. Do you want to take control? Can I go back here? Do you want to take control of your financial future and elevate your professional standing in the company? Quickly. How many yes are there? 1, 2, 3, 4, 5. Please quickly write yes in the chat box. All right. So good. Before I move ahead to the next slide, I'm going to ask one more polling question. How important is ongoing education in finance and wealth management for your career and financial success? How important? Is it not so important, somewhat important, or extremely important? Not so important, somewhat important, or extremely important? Right? Absolutely great. Last 5 seconds. 1, 2, 3, 4, 5. All right. So 76% says absolutely, extremely important. Sorry, extremely important, key driver for professional and financial advancement. 19% says somewhat important because it is actually a life skill. Financial understanding, wealth management actually opens up the mind. It becomes it so sharper, and you stay relevant. Okay, you stay relevant in the overall scheme of things. Okay, so now I'm going to request Ihina to move to the next few slides, and I'm going to talk about a great, training that has been created for people like you. It is called the Executive Program in Finance and Wealth Management. Executive Program in Finance and Wealth Management. This is a program which, can you move ahead, please? So what are the benefits? So these are the program which would help you achieve 3 different things. It is going to build your investment acumen, okay? Gain investment knowledge, which is crucial for long period success. Number 2, executive enhancement or advancement. Sharpen your financial strategies to spearhead leadership opportunities. And number 3, realize your career aspirations. So you would get the benefit of financial mastery. So it's a very sharp program for everybody who would like to achieve these three benefits. May I request Ina to move on, please? So in this, you are going to learn 5 things. You would learn how to start your investment journey. You would learn about what to study about markets. Okay, what to study about markets. Number 3, you would learn how and when to invest in the markets, build your portfolio, and you would learn the ways to grow your wealth. Okay, if your answer is yes to all of that, this is an executive program. Yes, next slide, please. This is a very intensive, next slide, please. This is a very intensive 15 hours hybrid program. Okay, it's a combination of self-learning and live classes, so as to build in convenience. This program is available both in English and Hindi. Okay, today I'm speaking in English, but this program is available both in English and Hindi. How many of you would like to know more about this program? Right, I would like to know, or I want to know, in the chat box quickly. Please write quickly, I want to know, in the chat box if you are really looking to know more about this program. Okay. 1 second. Quickly write in the chat box if you are looking to know more about this program. Is the chat box right? Okay. All right. Super. 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 So this is a special offering which has been crafted primarily for acquaintances and relationships of Pluxee. Okay. For the relationships of Pluxee. Move ahead, please. So the topics we would learn is about savings and investments and avoiding of speculation, influence of economic growth, inflation, and policy actions. Previous slide, please. Asset classes, equity and debt, and direct investing and investing through mutual funds. Okay, so it's a very comprehensive executive learning training program. Okay, next slide. So you would have access to exclusive learning materials, which would cover reading stuff, videos, tools, and resources. You would have access to mentoring and coaching sessions, and you will also get your financial health checkup done. All right. So I will request Ihina to move to the next slide, please. So then quickly move to the next slide. Quickly move through. So there are many people who have gone through these kind of sessions and so on. They are mostly from the services sector. So for your career transition, for your promotional potential, niche specialization, or even maybe for your side hustle. Okay? You can think about it for a business as well. So if you're ready to take advantage of a limited time offer available exclusively to the webinar participants. Next slide, please. So the cost of the program is actually 10,000 rupees, but as a special, Ina, keep moving to the slide. Keep moving, keep moving. The cost of the program is 10,000. However, as a special for all acquaintances of Pluxee, this program fee has been brought down to 2,999. So I would request Ihina to post the payment link in the chat box, and everybody would get this program at a special price of 2,999 right now. Kindly post the link in the chat box, please.
Hi, Sujoy. I'll just come in here. Hello, Sujoy. Are you able to hear me?
Yes.
Yes. We have limited time. Once Iniha puts the link in the chat, I'm sure a lot of people would want to join. But I just wanted to interject and say that If you have any questions relating to what has been spoken today in the webinar, you can definitely put it in the chat.
Yes. You can ask
For
all your questions to me now.
Yes, we can take. I will slightly over time. We can take about 2 questions. Are you okay with that, Sujoy?
Absolutely fine. You can write it in the chat box, or you can speak up whatever is comfortable.
Hello, Nikun bhai. Hello.
Yes, please. Yes.
Hello.
You can write your question in the chat box, please.
Sujoy, you can pick in case if I can see 2 questions, a couple of questions coming in. You can pick any 2 that you'd like to answer.
So, okay. The questions are done. How to pick a good stock to invest in? Okay, I will possibly take this one first. So, a good stock. What is the definition of a good stock? A good stock is one where we invest and the prices go up, right? I would presume that is what you mean by good. Uh, so idea is when we are investing, how do I identify whether others will also invest in that stock? So nobody is really sure about that, correct? So what generally has to be done is that when we are trying to identify a great stock, the first step is to look at the macro. Okay, what do I mean by macro? Like in general, whether people are investing. Okay, whether in general people are investing. Now, how do I identify that? It is not very tough. It is in fact the most easiest thing to do. In order to figure out when others are investing, we have to see what is the overall interest rate cycle. If the interest rate cycle is in a downward decline, then you would definitely know that in general people are investing. Okay, so that would create one problem is taken care of. The second thing that to look for is that when you're investing, there is a choice to look at the overall valuation of that company. So we generally look at a valuation called P by E, price by earnings. So what I would request is that instead of looking at P by E, we should look at the reciprocal of that, which is E by P. If we look at E by P, we would get to know that how much of money that we would invest in that company for a commensurate return. Okay, so E by P is something that I would strongly urge everybody to look at instead of P by E. So look at a reciprocal of P by E, look at E by P, and look at the interest rates declining path. These two, so the E by P is in general lower than the bank interest rates, then stay away. But if E by P is above the bank interest rates, then get in. Okay, so this is a very powerful way of looking to selecting the right stocks. So E by P, look at E by P. If E by P, so if I give you an example, so suppose P by E is let's say 25. Okay, P by E is 25. That means E by P will be 1 by 25. So 1 by 25 means 0.25, sorry, 0.4, which is 4%. Okay, 4% of the market. So that means markets have become very expensive. Markets have become extremely expensive. Then stay away. Because if SBI is offering 7%, and if you are generating just let's say 4% in your E by P, then stay away. All right. So that is one very powerful thing that we generally use to get a quick sense about what to achieve. Okay. How to decide when to book profit in mutual fund? I think there is no straight answer to this, but one small, very powerful thing that I want to say is that if you are looking to book profit in your mutual fund, you should book your profit when your goal has been achieved. Okay? Do not look to move out of the market just for the sake of it, or do not try to wait till you can get it for the sake of it, because there is no good time to invest, or there is not a bad time to exit also. Every time could be a great time, or every time might not be a great time, depending upon your final objective. Stay invested, and stay invested for a longer period of time, and longer, not for the sense of time, till the time your goal is achieved. Otherwise, it's not going to be really a fruitful, experience. What is FOF in mutual funds? FOF is a fund of fund. FOF is a fund of fund. So instead of investing in one fund, you invest in one fund and then that particular fund invests into multiple funds. Multiple funds. So it's a great way to diversify exposure. So instead of investing, let's say, into 10 different funds yourself, you invest into one fund and that one fund invests in 10 different funds on there. Okay. So that is a great way to get invested. Okay. I will take one more quick question. The question is, one second. How do I pick? What are your views on investing on buying a plot as an investment? Okay. Buying a plot and investments. One second. Buying a plot as an investment. So buying a plot as an investment is a great diversification. Okay, because land is a good asset to hold, depending upon which area that you are investing into, whether it's closer to a city or a river or a industrial belt and so on. So land is a great investment. So generally, large investments are made in land. We do encourage people to look at land as an investment in order for a diversification and so on. So we would generally say that if you are looking to invest into land, there are a few things that you should keep in mind. For example, see whether it is closer to a river or some water body or to a city and so on, whether it is some larger town planning tools coming up. But it's a great investment to have. But there is one big drawback of investment into land, which is lands could be slightly illiquid in nature. Okay, illiquid in nature. So if you would like to sell it off quickly, that is where the trouble may sometimes happen. You might not always find a buyer at the time you need one. But compared to that, investments into mutual funds or equities and so on are extremely liquid. So you can quickly come in and quickly get out when you want to. So land is a physical investment, other financial investments. Okay. Super. Any other questions? Anyone? Maybe one last one. If shooting.
Yeah, sure.
Okay, I do not see. Okay, there is a question saying that how useful will it be for a medium-term investor having invested for almost 10 to 15 years now? I mean, is it a very basic session? No. Where do you see markets going in coming times? 3 months. Okay. I would, so difficult to say whether markets would be in the next 2 to 3 months or 6 months. But in general, if you notice, markets have a tendency to go upwards. Okay. Because why does the market go up? Markets have been going up because of two reasons. One, the companies in which we invest have been starting to do well, number one. And number two, the companies or the people who have been investing in these companies have also been earning more. So it's both a demand and a supply action. The demand and a supply action. So in the next 2 to 3 months, it would depend. So if we want to see what will happen in the short term, we have to look at the interest rates. But if we have to look at what is going to happen over the long term, we have to look at fundamentals. Clearly. So in the next 2 to 3 months, if you see interest rates coming down, market prices will go up. But in general, long-term trend has been upwards. Short-term has been difficult to predict and it is best avoided. But if you would like to still gauge like what will happen in the next 2 to 3 months, there are two ways to look at it. Look in the way the interest rates are headed, or look for signs through your technical analysis. Look for maybe a relative strength index or a Bollinger Band. These are great, leading indicators to figure out in which direction markets are. Super. I think,
so great. Yeah, I think we've taken more of your time, Sujoy. I think I'll stop it there. It's been a great session, and I'm really, really glad that you came again. I hope that we can do more webinars together again. And I really hope that it's been helpful to everyone who's joined us today. And a big thank you to OAWA as well for organizing this, for helping us do this for our consumers. Thank you so much.
Thank you. All the best, everybody. Thank you. Take care.
Thank you. Thank you so much. Thank you, everybody, for joining.
Bye.
Bye-bye.
The webinar has ended. Thank you for joining. Goodbye.